Hello, Avila Advantage students. This is our 8-week course in finance. I want to introduce myself. My name is Joe Barnhill. I'll be working with you online for the next 8 weeks. I had an opportunity to redesign this class over the summer, so I think the book that we're going to be using here are Foundations of Finance. I think you can find it an easier book to work with than maybe some traditional finance books that we've used in the past. And what I plan to do is I'm going to post these video lectures each week as a way to kind of give you tips and insights and things to think about for the course. In the beginning, what I'd like you to do is just go through the entire course syllabus, look at the modules, look at everything in Canvas. I will be adding additional items to the course as we progress through those, but week 1 is all ready to go. And you'll notice that I also have homework templates out there for you. So use the templates, will make it easier for you. Where I put in just like little yellow highlighted, that's where I'm expecting you to use Excel to put a formula in there. And as we get into other time value and money calculations in later chapters, I'll give you probably some additional videos or additional insights how you can calculate those things. Well, I want to talk a little bit about what we need to do this week. For week 1, you're going to have to read chapters 1 and 2. You're going to do a forum discussion where you're going to have to go out and look at the history of the Treasury yield curve and how it interacted with the S&P 500 market, and do a little discussion of interest rates in general. So I put a link out there under Money Chimp. I think you'll find that interesting, where it looks at the historical returns in stock markets. And historically the stock markets return 11% a year. It doesn't mean that we're going to continually have this into the future. There's a lot of volatility, up and downs, that we have in this returns over a period of time. But it is something that we'll be using this course to help us benchmark for such things as the capital asset pricing model that we'll discuss later in the course. What is the appropriate rate of return for investor? Some highlights as we look at this chapter 1 and talk about introduction to foundations of financial management. The goal of the firm is to make a profit or to provide value to the shareholders. So finance is a great way to measure, are we doing that, and how are we making sure that we meet the right rate of return for investors. But they look at these 5 principles, and these hold true throughout the book, that it's cash that's king, cash flows that matter. We look at money as time value, so there is opportunity cost, and you're going to get some skills at calculating time value money calculations in week 2. Risk versus reward, how much risk we're willing to take on. We'll look at evaluating projects in this course. We'll look at such things as net present value, internal rate of return. Market prices are generally We're going to look at whether markets are efficient, whether information is accurately reflected in the market in that price. And then conflicts of interest cause agency problems. So the people that we hire to run these firms, there can be the principal holders or the shareholders, and the agents are the CEOs, the CFOs, and the manager of the company. Are they looking after the best interests of the shareholders? And you'll see that throughout case studies through the book. A little bit more about chapter 1. You've probably been exposed to this before, about the different legal forms of business, so that will be a little bit of review for you. Chapter 2 starts to look at the financial markets in general and interest rates, and this will give you a little bit of overview how an IPO process happens, how securities are brought to the market, the difference between a primary market and a secondary market. Most of what you hear about in the news is the secondary market. And then the later part of the chapter deals more with the interest rates and the Treasury yield curve, looking at how do you come up with this total rate of return. Some of it might be a risk-free rate. There could be other premiums that we pay in these rates. And there's a page later in this chapter, they give us some historical interest rates on page 34 about rates of return and inflation, because we do have to take in consideration inflation in our rates of return. And then a little bit later, go through page 38. It says, do you get it? And it kind of helps explain how this was derived, and this will also help you with the homework problems. So once again, I'll be doing this weekly, so I'll post a mini lecture out there. Now that I have a webcam, makes me a little bit easier. This is how I kind of give you a lecture each week. And there might be future lectures that also incorporate screencasts, where I may show you how to calculate a certain type of problem, like a future value problem. But anyway, do email me in the Canvas environment. Make sure to check your settings and all that stuff too, where you want your email to go. But I'll try to check email daily, get back to you at the following day at the latest. But we have a small, nice cohort here. I think we have about 8 to 10 students. So we'll get to know each other in the first forum discussion. But otherwise, have a great week, and we'll talk to you soon.